Welcome to vTalkInsight, Market Drivers Daily for May 6, 2026. Middle East headlines have knocked roughly 10% off crude, pulled global yields lower, and fueled fresh risk on moves just as AI exuberance hits new highs. Let's unpack how shifting geopolitics around the Strait of Hormuz, the AI build-out, and a still stressed energy system are interacting across equities, rates, and commodities. Geopolitics is still the main macro driver, but the tone has flipped from pure escalation to a tug-of-war between diplomacy and lingering risk premia. Reports that Washington and Tehran are edging toward a memorandum of understanding, including safe passage through the Strait of Hormuz and potential sanctions relief, have triggered a sharp drop in oil prices and a powerful bid for risk assets. Crude benchmarks have fallen by around 10% on the latest headlines, with Brent still well above pre-conflict levels but down materially from recent peaks. That move has pulled U.S. Treasury yields lower across the curve, with 2- and 10-year maturities both dropping close to 10 basis points as markets reassess the inflation path. Equity futures are higher, global indices are hovering near record highs, and strategists highlight that falling oil eases pressure on central banks, potentially giving the Fed and a European central bank more room to pivot toward an easier stance if the escalation holds. Yet beneath the near-term relief, the broader geopolitical backdrop remains tense and structurally supportive for defense and security spending. European governments are accelerating defense outlays to meet or exceed NATO targets, with Germany planning to lift defense toward 4% of GDP and contractors reporting double-digit order and revenue growth in air defense systems as conflicts in Ukraine and the Middle East reshape priorities. At the same time, trade frictions are intensifying. The U.S. is threatening 25% tariffs on European autos if a delayed deal is not ratified. Steel and aluminum tariffs around 50% remain in place. And China's reported non-compliance with sanctions on Iranian crude is set to feature prominently in upcoming U.S.-China talks. The counterpoint to today's optimism is that the physical and political realities around Hormuz are far from settled. Iran and the Revolutionary Guard retain control over key choke points, signaling they are unlikely to surrender their ability to disrupt shipping even if a deal is signed. And some analysts warn that markets may be too quick to fade the medium-term risk of renewed commodity shocks. There is also concern that later this year a combination of a new Fed chair with a tougher stance on inflation and potential petroleum shortages could generate a sizable equity drawdown if negotiations stall. For now, the key markers are whether a U.S. Iran agreement is actually finalized, how quickly ships and crude flows restart through Hormuz, and how far Washington pushes on European auto tariffs in parallel. Those outcomes will determine whether today's compression in oil, yields, and volatility becomes durable or proves to be another geopolitical head fake as we turn to the AI story. Artificial intelligence remains the dominant engine of global equity performance, with fresh earnings and capex signals reinforcing the scale and breadth of the build-out. AMD has become the latest focal point, with data center revenue growing close to 60% and management lifting its server CPU growth outlook to more than 35% annually through 2030, implying a total CPU market above $120 billion and sharply higher AI-related demand. That guidance, alongside expectations for server AI revenue to rise around 70% year-on-year next quarter, has driven a surge in AMD's share price and underlined how AI infrastructure is now the core growth vector in semiconductors. The demand picture is broadening well beyond a single vendor. Samsung's market capitalization has climbed past $1 trillion on the back of booming AI memory sales, while AI chip orders are strong enough that Infineon has raised full-year guidance as it benefits from both AI and automotive applications. Hyperscalers are projected to spend $700 to $725 billion on capital expenditure through 2026, reshaping expectations for CPU to GPU ratios as enterprises push toward almost one-to-one compute for proliferating AI agents. Alphabet is leaning into this trend, using its low-leverage balance sheet to raise about $7 billion in multi-currency bonds to fund AI infrastructure, and is reported to be discussing a large, multi-year Anthropic deal that would further cement its role in AI cloud and custom chips. Beyond core semis and hyperscalers, AI adoption is accelerating across finance and the broader real economy. Anthropic is launching tools tailored for banks, insurers, asset managers, and fintechs, and is deepening its footprint via joint ventures with firms like Blackstone and Goldman Sachs. While specialized AI platforms are emerging that aim to provide algorithmic, human-free financial advice with real-time portfolio monitoring. Asset managers are embedding AI into research and workflow. Investing in upskilling to boost productivity, and data center infrastructure is increasingly treated as a distinct asset class as financing for AI-oriented facilities ramps up. In macro terms, some estimates now project AI-driven productivity gains adding roughly 2 percentage points to U.S. GDP growth per year for 5 years, translating into mid-single-digit annual earnings growth for large-cap indices without necessarily stoking inflation, if the transition is smooth. The upside narrative is powerful, but the risks around AI are also becoming clearer. Global equity returns are increasingly concentrated in a narrow group of AI infrastructure stocks, and U.S. indices dominated by big tech and AI have become less sensitive to the traditional economic cycle, raising concerns about crowding and reduced diversification. There is talk of AI investment potentially exceeding $1 trillion over the next year alone, which would underscore conviction in the theme, but also heighten the danger of capital misallocation and volatility if earnings or regulation disappoint. Many software-as-a-service firms face margin pressure as AI erodes pricing power and lowers barriers to entry, and private equity-backed software with high leverage may find it difficult to fund the pivot required to stay competitive. On top of that, security vulnerabilities are drawing attention as Chinese AI models move toward parity with Western peers. Regulatory debates remain unresolved, and political and community backlash against energy-hungry data centers builds, particularly where electricity grids are already strained. From a portfolio perspective, that mix argues for watching not just headline winners like AMD, Samsung, and Alphabet, but also the second-order effects on disrupted incumbents, credit quality and leveraged software, and the liquidity impact of upcoming AI-related IPOs as we shift back to the energy and supply chain side of the story. The third strand today is that, even as oil prices fall on diplomacy headlines, the underlying energy and supply chain picture still points to a prolonged period of tightness. Compared with recent days when the Strait of Hormuz conflict kept crude in triple digits and pushed global yields higher, today's pullback reflects a repricing of the geopolitical premium rather than a resolution of physical imbalances. Brent crude is still reported to be more than 50% above its pre-war level, and some analysts describe current dislocations in oil and liquid fuel markets as unprecedented. On the supply and inventory side, estimates point to a global deficit of roughly 13 to 14 million barrels per day, with weekly draws of around 25 million barrels even before peak seasonal demand arrives. Fuel products look especially fragile. U.S. diesel stocks are already about 11% below their 5-year average. Jet fuel and LPG supplies are tight, and both European and U.S. fuel inventories are being depleted quickly, raising the risk of regional shortages by mid-year. Even if disruptions in the Gulf ended immediately, logistical and operational hurdles mean it could take at least 3 months to start restoring flows and potentially years to normalize disrupted liquefied natural gas and crude streams from the Gulf and Iraq. These physical constraints are feeding through to consumers and inflation data. U.S. gasoline prices have risen above $4.50 per gallon on average, the highest seasonal level since 2022, and are expected to stay elevated well into the summer, even if they do not spike to $5 nationally. Higher fuel costs have already contributed to the first monthly decline in one key economic activity index in more than a year, with noticeable pullbacks in discretionary spending categories such as travel, entertainment, and dining, and an 18% drop in new credit applications, signaling rising consumer caution. In Europe, CEOs continue to flag energy costs, inflation, and softening demand as central to their outlooks, while airlines wrestle with soaring fuel bills and operational disruptions, including thousands of flight cancellations. Corporates are not standing still, which creates a more nuanced backdrop for markets. Some firms, such as Ahold Delhaize, are largely hedged on energy into 2026 and focus on managing input costs through supply chain efficiencies, while industrials like Continental report strong profitability and highlight inventory building and diversified supplier bases as buffers against Persian Gulf tensions. In sectors facing acute bottlenecks, companies are innovating, Phillips is responding to a roughly 20% helium supply cut tied to Middle East conflict by rolling out helium-free MRI technology, and policymakers in the U.S. and Europe are working to rewire critical mineral and energy supply chains to reduce dependence on geopolitically exposed sources. From a macro standpoint, markets still expect energy prices to remain elevated relative to pre-crisis norms, flattening oil futures curves and pushing break-even inflation back toward levels last seen in 2022, which in turn risks keeping central banks cautious about cutting rates. The open question is whether today's apparent escalation in the Gulf will prove sufficient to ease these structural pressures, or whether the combination of persistent tightness, consumer stress, and policy constraints keeps stagflation risk on the table as we move through the summer. To wrap up, Middle East diplomacy has taken some heat out of oil and bond markets, but the geopolitical risk premium has not disappeared, especially with unresolved questions around Hormuz, trade tariffs, and a broader U.S.-China relationship. At the same time, AI remains the clear performance engine for global equities, powered by massive chip demand and hyperscaler capex. Yet the leadership is narrow and increasingly exposed to regulatory, security, and capital cycle risks. Beneath the price action, the physical energy system is still tight, from diesel and jet fuel inventories to power grids strained by data center demand, which keeps inflation and policy uncertainty in play even if headline crude stays off the highs. Keeping an eye on the intersection of these themes, concrete progress on an Iran deal, AI earnings and capex guidance, and real-time indicators of fuel and power stress will be critical for understanding how risk is being repriced across equities, credit, and rates. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.